Everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter like we normally do, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in, take a look, see what people are sharing. If you want to follow me at Fire Finance, and if you want to join our community, finding-value.com. I dive deeper into all these topics and subjects. Again, looking for investment opportunities, sharing it with everyone. We talk a lot of macro. We talk individual companies, fundamentals, technicals. I basically try to talk about whatever I know during those Q&A sessions. I also do midweek updates from Tuesday and Wednesday. That's when they get released. Talking about what I like, what looks good, and why I am buying what I'm buying. So if you're interested in that, we got the special coupon code. Special is the code. 50% off the first month only, and a larger discount on the yearly membership. So Mike Zaccardi here, Mag 7 ETF, Mags down 6 weeks in a row. This looks pretty rough here, guys. Pretty rough. So I think it could easily continue to sell off. You can see the volumes kicking up. It doesn't look good for the Mag 7. Now, this was expected. Now, I didn't know when it would turn over. But what I'm saying is, or what I thought would occur, is that we are coming out of bottoming patterns in commodities across the board. We're putting in topping patterns for Mag 7, S&P 500. The valuations are all overvalued in those sectors. At some point, I said, you know what, this is going to roll over. That's my opinion. Is this the beginning of the rollover? It sure looks like it. And when the volume kicks up like this, it generally is a pretty good indicator. Now, do I know with 100% certainty? I don't. You never know with 100% certainty. But what you do to protect yourself is to stay in the undervaluation. Avoid overvaluation. Because eventually the overvaluation will correct. And that's how you stay away from it. So it's not that I know that something will roll over or move. We use technicals to verify that, yes. But the valuations ultimately, over long periods of time, will correct around the mean. And if you're in an overvaluation, it will correct back to the mean and probably go to an undervalued state eventually. In the cycle, what the cycle generally does is it flings these things from undervalued to overvalued back to undervalued over time. And the cycle duration, the length of the cycle, is generally something on the lines of like 10, 15 years. So you could see an underperformance of stocks for 10 or 15 years, and you could see an outperformance of commodities for that 10 to 15-year period, where commodities go from undervalued to overvalued, and Mag 7 goes from overvalued to undervalued. And that's the cycle. That is the cycle. And those are some of the things that we look at. And you can see bottoming patterns all over the place in commodities and precious metals. Semis, so semiconductors, lead on the way up, and now they're leading the decline and have been for months. Stocks not showing any sign of reversal. When a former leader gives you clues, believe it. Lots of smart professionals have been going through the exit. All moving averages now heading lower. Till something changes, this is a canary in the coal mine. This here is the beginning of the potential break in semiconductors. What he's saying is that this is a leader, and it's leading everything lower. And again, I didn't know. I've been saying this since 2021, 2022. I said, we're going to see a top in the NASDAQ. We're going to see a top in this. Now, this here does look like that top materializing. And these tops take time because we are ending a bull market in stocks, a big bull market, potentially, from 1982 till today. That's the big secular trend. Interest rates were the driver of that trend. And now interest rates are starting to turn higher. And what we're probably going to see is higher highs higher lows, and we'll use the 10-year just to show you what that looks like. This is your 10-year yield. Your bull market for stocks were from here all the way down, and now we've reversed up. And the pressure from interest rates is gonna cause the rollover potentially in the stock market. So when we back out and we look and we kind of go over here, it's possible that we break out and do a return move like that. This would be a slowdown in the market, a crash, a recession, maybe. But again, that isn't put in stone. We could continue higher, which is another possibility. You could look at some of these previous kind of turns too. The downtrend breakout, it went sideways for a while and then uh, built steam upward for interest rates. This one's been a pretty steep move in interest rates. So there is the possibility that we get a return move before heading higher. This return move does not mean that interest rates are going back to this 40-year decline. We're going to do higher highs and higher lows for a period of time. And I think it's going to put pressure on the stock markets, the valuations of the stock markets, and they will correct lower. That's what we're seeing, correcting lower. Here's Spencer. He says, looks like we're going for 0 of 3 on the Besant's 333 plan. Deficit looking like it will be 8% of GDP in 2025. Oil output looks flat year over year at best, possibly even negative. And GDP is printing negative right now. And flat at best if you take out the import surge, which you shouldn't take out. 0 for 3, guys. 0 for 3 on his 333 plan. I don't think they have a chance of increasing oil output. I really don't. They need like $100, $110, $120 oil to get that output up. And that may not even increase output that much. Maybe of natural gas. Oil, it says specifically oil output that I'm talking about. I don't even know if they can get oil output up ever again. I don't know. Out of shale, at least. Deficit's looking like it will be 8% of GDP. I don't know how they're going to reduce that either. Really don't. And then GDP, good luck. I mean, there's some momentum behind this, and I think the market needs to shift. What do I mean by shift? Well, the market's all tied up in these companies that existed on low interest rates. The consumers, too, existed with all these low interest rates. So there was excessive money in the system jumbling around, speculating on crypto, speculating on AI stocks. It basically is a huge speculative boom. Now, that could easily unwind. And if it unwinds, which I think it will, you're going to start to see a huge rotation in the markets of everything. The markets are going to have to reconfigure itself to some degree away from tech and probably towards real companies, steel companies and oil companies and energy service and all these different sectors. And during that transition, which I think we're in right this second, that's what happens. You get that transition. And sometimes you get a slowdown, sometimes you get a recession. There's people who think that every time you get these like turns that you will 100% get a recession. It depends how you calculate it. If they have 8% of GDP, I don't know if we've ever had a recession with 8% deficit spending. So that's where things get real difficult. It's a rotation. It's a transfer. Some stocks will go down. Some will go up. There's going to be push and pull where if the stock market sells off rapidly, it could yank down other sectors that may not be correlated with it. It's kind of a sell everything type of event. All of that's going to happen right now. Lots of volatility. Rock bottom entries. The silver lining in all of this. The S&P is entering a bear market, yet the DXY can't hold a bid, the dollar. It's the perfect storm for capital rotation into commodities. It is. Commodities are priced in the dollar. And then when the dollar declines, you'll see the S&P and NASDAQ decline with it. Money will rotate to stronger currencies. That's the game. That is the cycle. That is the game. That's what you need to learn. And that's what you want to really focus on, learning the cycle. And when you learn the cycle, it gives you confidence in the longer term on where to be positioned. If you start to line up all of these things, you will increase your odds of success. What are some of the things? Lengthen your time frame, buy undervaluation, which keeps you in the right side of the cycle. Know the cycle where you kind of understand roughly where we're at. You can't be perfect. It's not a precise area. Like, you won't know the exact bottom. You won't know the exact top. What you'll do is you'll say, within a few years or months, you can kind of get roughly in the general location. Um, People think, I think what people think in their heads is that everything is very precise. It's not precise. You get general areas of accumulation, general areas of distribution, general areas of XYZ that you want to be positioned when something's undervalued and low. That's kind of how the markets are. It's not about being precise. Like, everyone that I see that uses precision, I don't know if they understand the markets that well. So the traders will all say, well, I'm going to enter on this breakout and then put a 6% stop loss. And most of the time, they're going to get stopped out. And I don't use stop losses. I let things ride. And I use undervaluation as my tailwind. Undervaluation, market cycle turning, all of those things are tailwinds. Could I be down on a stock 20, 30%? Oh, yeah. And have I ridden through stocks that have pulled back 50+% in the middle of a cycle? Oh, yeah. Definitely all the case. If you're trying to get maximum returns. So you kind of have to understand the cycle to get the confidence to do that. If you want to make 10, 20, 30 times your money, you're going to have to endure 50% pullbacks. That's just part of the game. You're going to be in things that move fast and move quickly. Uh, Trying to catch the bottom within 6% of a very fast moving stock that does 6% daily swings is damn near impossible. So you have to figure out a strategy that works, that if you're going to play in the more volatile area, you're going to have to somewhat get a strategy that works with volatility, that you can manage emotionally, and then you can ride the damn thing up. But commodities are a tough ride. If you can master commodities, you've mastered the entire market. Because you go to tech, like, those things are so easy to ride. It's so easy. Like, they just go up and down. They're not as volatile. They're more stable. They generally go up in a more stable fashion. The problem is we're just not in that part of the cycle to be in tech or to be in the S&P 500. We're in the wrong spot of the cycle. Rig count's not moving at all. No signs of drill baby drill anywhere. Yeah, I think people are catching on. I think people are catching on. It's decline, baby, decline. Coming down, JC Parrott says, do you think you have enough energy exposure? Yes, I do. Um, I am heavily exposed to energy, heavily exposed to precious metals. Those are the two areas that I think will do phenomenal. Phenomenal. And I think all of the precious metals will do phenomenal. I think all of them. Maybe palladium's the only one that I have it kind of iffy on, but all the other ones, oh yeah, they look fantastic. Gold, silver, platinum, fantastic. Energy looks absolutely killer for a setup here on the longer term, next 10 years or so. Looks killer. We'll talk a little bit more about energy down below, but uranium is going to be in this mix, so uranium's going to kill it. A lot of the base metals like copper is going to kill it. Mining companies are hopefully going to do quite well. I have the most conviction in energy, though. By far, the most conviction in energy. Everything else is a derivative of energy. The whole system, the centerpiece of the whole system is energy. Energy backs our currency. Energy backs our ability to manipulate the world around us. So we use equipment that harnesses energy to manipulate the world. That is as easy as you can get to a description of what humans are doing on planet Earth. We can manipulate it through using electricity and converting electricity to pressure, power, milling, turning, all sorts of things. Um, we can also manipulate the world by gas and natural gas and uranium, heating, cooling, all sorts of things. So energy is the centerpiece. That is what inflation has to travel through, and that's why energy is so good. I also think precious metals is a function a of people's, I'll say, discomfort with holding bonds and currencies. And in 1980, that was kind of the most discomforting era of holding bonds and or cash. But I do think that things might be different. We'll see. What we want to see next is, are we going to start to roll over in production of commodities? If we do over the next 10, 15 years, depending on what they are, then I don't know if the currency systems can survive that. I don't know if they can. But there's a lot of things that we haven't been able to produce more of. Platinum, palladium's probably in decline. Copper could be entering decline. Oil could be entering decline. There's a lot of things that could be. I don't know for sure yet, but they could be over the next 10, 15 years. Michigan long-term inflation expectations hit a 32-year high. That's not what you see if we've got a recession that's deflationary. You don't see inflation expectations hitting a 32-year high. That just seems weird. The narrative: Bissett will scare capital out of stocks into 10-year U.S. Treasuries, lowering the 10-year yields so he can term out the U.S. debt. So he can basically release 10-year bonds. Had a bad month of March. The SPX Blue down 6%, but 10-year UST yields are flat. There's a reason Yellen didn't term out U.S. debt, and it wasn't because she is stupid. Probably because she couldn't do it. So what does that mean, term out? What they're trying to do is they're trying to take short-term debt that's in the system and try to get it back out on the 10-year. So they're trying to release new bonds at 10 years, sell it, and get a longer duration on the bonds. The problem is the market doesn't want to give it to them. Nobody wants our bonds out at the 10-year or 30-year because of these inflation expectations. So they're in a conundrum with releasing bonds, and they can't release them on a 10-year yield. So what they're doing is they're stuck to releasing bonds on the short end of the curve. And then you've got a cycle there where when they roll over more quickly, your yields going up is going to cause a big problem in interest payments. You're going to balloon the interest payments. So they're trying to create a scare where yields drop. They offload a bunch of debt to people on the longer end of the curve to refinance the debt on the 10-year or 30-year or something on the lines of that. That's what they're trying to do. Against all odds is a major shift happening. Look at this. This is the U.S. dollar index. We've got the cycle down, 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 and looks like we could potentially head lower for the DXY. Huge, major shift, and that shift that he's talking about is away from tech and S&P and financial assets towards commodities and precious metals. Here's Flo's Tom Laughrey. Our models predict peak production from the combined Permian, Eagleford, and Bakken in May of 2025. So they're coming out saying it's peaking in May of 2025. That's right across. I mean, that's a few months from now. We've also seen some CEOs and insiders, specifically, and I talked about her quite a bit, but Vicky Holub, of Occidental Petroleum. She says after 2025, we're going to be in an oil shortage. After 2025. So here's more information, a peak in May of 2025 that runs right with Vicky Hollow's call that she made in 2024, beginning of 2024, saying that we're going to see oil shortages past 2025. Now, here's something to think about. If those shortages occur, we are also entering this with very little commercial inventories and strategic petroleum reserves. So if we do have a problem and this starts to roll over like they're showing here and demand continues up, how are they going to refill the inventory rooms? They're not going to be able to. So, I mean, when you refill those inventory, guys, we're talking about hundreds of millions of barrels. We are short in commercial and SPR. So if we're short all of that oil, I mean, it would take many years to fill it back up, even if you had a surplus. If you were going to fill it up, fill up these things, 400 million barrels, just a round number. So 400 million barrels, and you're doing 1 million barrels per day. That's 400 days. That's over a year. It takes years to fill it up, and it took months to drain it. This is what's coming. Such a great setup for us. Platinum and palladium are the most asymmetric plays in the metals market right now. Most are snoozing at the wheel on the setup. I like that. Yeah, I agree. They are some of the most asymmetric plays. I also think oils, a lot of people are sleeping on oil. I think oil's going to be big, big, big. And that's why up here, do you think you have enough energy exposure? I do. I'm riding this thing, guys. I'm silver, gold, palladium, platinum. I like those two. The physical metals, and then energy and energy service. People are going to panic at some point here. So you have to panic buy when everyone else doesn't care about something. So if they're not caring about something, you get it when it's low. No one's giving a crap about it, and then you just wait. You wait for these decline rates to just keep edging closer to a rollover. Now, am I betting that May 2025 will be the absolute peak? I don't know. Do I think it will peak in the next 3, 4 years? Yes. That's what I'm betting. I'm betting that this will roll or go flat in the next 3, 4 years. If it rolls over now, it just expedites the process. When people figure this out, if this rolls over and people figure it out, boom, oil's going to go. It could go big. It may even drive us into a recession. Mr. Market has spoken, sell stocks, buy commodities. This is right here. This is the Spider S&P. We've broken the uptrend and we are getting larger selling pressure on higher volume. Momentum failure. Yep, that's the cycle. Goldman Sachs raises gold price to $3,600 to $4,000 by next year. That's pretty big. A lot of people running into gold. It's the beginning of the cycle. Central banks have been buying for a while. They knew the cycle was coming. Here's another thing. If oil does roll over, this is going to screw bond markets and currencies. You're going to see an interest rate spike. It's probably going to impact the stock market pretty negatively. Stocks, remember, most stocks, which are just companies, most companies are what they do is they grab energy and commodities and combine them together through a certain design, and then they kick out a final product. If you have problems gathering energy or you have problems gathering the commodities that you need as your inputs, if they have problems, what's the value of that company? If they can't spit out the products that they want on the back end. Now, some people say, oh, they'll just change the design. It depends what commodity is the problem. Oil's the number one commodity. Silver, I think, in terms of its uses, is number two. In terms of uses, not volume, uses. So I think that this being the most versatile commodity that makes the biggest difference, in the economy. I think this is a pretty surefire bet. I think so. That's them on gold, and I think gold's going to have a real good run along with silver and platinum and palladium. I think they're all going to run, and it deals with the people will figure out that the bond market's not a great way to store value. Then they're going to look to something else. They're going to realize that the dollar is not a good store of value. And then they're going to look around and say, well, stocks might not be a good store of value because they're going down, number one, because of the bigger cycle. And if in the future they have problems with a transition from where we are today to whatever next energy sources and or commodity sources are, there could be a big problem with basically shifting from old assets to newer assets. The assets aren't as big, they're smaller, they've got lower ore grades, they're not built yet. Nationalization, problems bringing them on, permitting, dude, there's so much here, so much risk that it could get quite interesting the next 10, 15 years. So if there's major problems, then there might be problems obtaining commodities to spit through manufacturing facilities out in the future. And then people will start to panic. Even the companies could panic, and they start to panic by silver mines, and they'll start to panic by copper mines, and something could be different out in the future, is what I'll say. They'll start to panic. There's still a bit of time to get off the dance floor and jump into the lifeboats. So what is this? And this is Germany back in when they had hyperinflation. So this is the value of one gold mark in paper marks. And look at the fractal: cup, handle, breakout, and then straight vertical. Cup, handle, breakout, and then straight vertical. It's going to come. Is this the beginning of when we should start to worry? I don't know. This looks pretty dang similar, though. It looks pretty dang similar. The fractals. Do we have the same market conditions? They're very similar. Here's a cool fact, guys. If you guys want to know, platinum in this time frame, it was priced, and I don't know if it's going to repeat, but it was priced at 5.5 times the price of gold. 5.5 times. So, yeah, I like my platinum. Shabam Garg says we've got Alberta crude storage remaining at multi-year lows, leading to exceptionally tight heavy oil differentials throughout the 2025 strip. With one of the major oil sands E&Ps short production on their March nominated barrels. Look at this, guys. We're low on all these inventory levels in oil. It's across the board. I mean, this is Alberta storage. We're low here. We're low in U.S. commercial storage. We're low in the SPR. China's inventories are low. We're low everywhere. How do we have prices down here? And how are they staying down? Are we going to have, is there something like an engineered recession coming? Do people know something that maybe everyone else doesn't know? I don't know. It's remarkable how every Trump action has taken with the assumption that he controls everyone else too. Trump warned that U.S. automakers not to raise prices in response to tariffs. What? I don't. It just seems weird to me. When I read that, it's like, oh, don't raise your prices, guys. Don't raise them. It's like, who are you to say that? Like, they're going to do whatever they want. I'm going to skip through that one. That one's a big thread. Paulo Macro says production net of LNG and MEX is going to have trouble sticking much above 90 billion cubic feet, even with associated gas from gassier Permian due to lack of egress. H6 to J6 already smelling the problem. We'll see here. And he's responding to interesting forecasts for the U.S. nat gas storage from here, and this is where they've got it going on. We're at the low end of inventory levels. We're getting towards the lower end. Problem is, inventory levels on a days of coverage is smaller. It's going to be harder to bring us back to this upper end. We'll see if we've got the production. And people are saying, we may not have the production to get us back up to this top here with everything that's going on. So I don't know. I'm not going to do anything. I'm going to stay long natural gas. Good luck to what's coming here. A lot of people think that there's a recession. I better sell. Guys, I think we're going to start maxing out fields here. And we need to start drilling more. So what does that mean? I'm not saying that the fields can't produce more natural gas. What I'm saying is we have maxed the fields for the price that we are at. We might need $8 a million cubic foot MMBTU. We might need $6 or $8 or something to get us back up there and have it be stable and stay there for a while. Otherwise, we'll get these huge price spikes. We don't want spikes. We want everything that you do in life. I'll just say this in kind of in general. You want consistency. You want someone to be reliable. You want predictable things, predictable output, predictable inputs, predictable. Right now, all I see in these markets is unpredictable. It's uncertainty. That's not good for markets. Uncertainty is horrible. We don't know uh, oil price uncertainty. People talking about $50 oil, and all the oil companies like, well, we can't make any money at 50, so we're not going to drill. We want predictable, stable outputs. We want predictable, stable $90, $100 oil. We need that for stable, predictable outputs from oil. All of this movement up and down and the weather being interjected in natural gas, that's all unpredictable stuff. And it's horrible to try to control things that are unpredictable. Tariffs on, tariffs off, unpredictable, uncertainty, not good. They printed 8 trillion, gave you $1,400, sent the rest to their criminal friends, and left you with the inflation. Yeah, pretty much. Pretty much. More water's coming out of the unconventional wells than hydrocarbons. It's a supply picture problem. It's ravaging new records every year. So water to oil production ratio across U.S. shale basins. Usually in a pretty good well, you're under a 50-50 cut is what they would call it. When you get above the 50% cut, you're basically kind of screwed. We're at 77% water cut in water to oil production ratio in U.S. shale basins for Permian. 51 for Eagle Ford, 58 for Bakken, 67 for Appalachia. That's pretty bad. That's pretty bad. Silver, the time is now ready to rip here. That looks absolutely fantastic. Tomorrow's the first notice for gold futures deliveries. Bankers are indeed crap. They are. Silver miners to S&P 500 ratio breaking a 14-year downtrend line. That's just the beginning. So what we're seeing is the S&P 500's rolling over at the same time that silver miners are starting to roll up. That's the cycle. That is the ratio. That is the cycle, and it is telling us about market conditions. Here's another one. Does the bond market have it right? So TIPS divided by IEF, that's the inflation-protected treasuries versus the nominal yielding treasuries. It's going up. There's a strong correlation between crude oil futures and this ratio. And right now you can see there's a divergence. These are going up and somehow crude oil is staying low. It's almost as if the scent is in the background with Powell and all these guys saying, hey, is there any way we can hold oil down for a little longer? Because they generally move together here. It's pretty well correlated. This is moving up pretty quick, and this is just sitting here. Huh. Interesting. What I'll say. And that's where we're going to end it, guys. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got the question and answer session going on today, Saturday. It's at 7 a.m. Mountain Time. If you guys want to join, it usually goes to 10 or 11 a.m. And that's kind of where I cut it off, Mountain Time. But that's all I've got for today. So we'll catch you next time, guys. This is Finding Value.